90% of day traders lose money. Not eventually, almost every single year they trade. And yet, every single day, millions of people log in and try anyway. So why would smart, rational people keep doing something that statistically fails? The answer isn't about intelligence. It's about how the human brain is wired to respond to risk and reward. By the end of this video, you'll understand exactly why the trap works and how to spot it. Let's start with the dream that pulls people in. Day trading promises something almost nothing else does: total freedom from a boss. From a schedule, buy low, sell high, all before lunch. Work from a laptop, from anywhere in the world. Social media is full of screenshots, huge green numbers, luxury cars, thank you day trading captions. It looks simple. Watch a chart, click buy, click sell, repeat. But that simplicity is an illusion, and it's the first thing that gets people in trouble. Because behind every trade, there is a market built by professionals. For professionals, retail traders, regular people, are competing against banks, hedge funds, and algorithms. Those algorithms execute trades in microseconds. A human reacting to news is already too late. Every trade also has hidden costs: the spread, the fees, the taxes on short-term gains. That means a trader doesn't just need to be right, they need to be right enough to cover all of that. Studies tracking real trading accounts found the same pattern again and again. The vast majority of active traders underperform a simple, boring index fund over time. So the odds are already stacked before a single trade is even placed. And yet, this isn't really a story about odds. It's a story about the brain. To understand why people keep trading, we need to look at what happens in the brain during a win. When a trade goes well, the brain releases dopamine, the same chemical involved in nearly all rewarding experiences. That feeling is real and it's powerful. But dopamine isn't only released when you win. It's also released in anticipation of a possible win, even before you know the outcome. Even a near miss a trade that almost worked triggers a similar dopamine response. Your brain doesn't clearly separate "I almost won" from "I actually won." Both feel exciting. This is the exact same mechanism that keeps people pulling a slot machine lever. Casinos design their machines around near misses on purpose, because near misses keep people playing longer. Modern trading apps, with their charts, colors, and instant feedback, work in a strikingly similar way. That's not a conspiracy theory. It's simply how engaging, fast feedback interfaces are built. Psychologists call this a variable reward schedule. Rewards that arrive unpredictably. Unpredictable rewards are, counterintuitively, more addictive than rewards you can always count on. A steady paycheck rarely creates obsession. A slot machine or a trading app often does. Every time a trade wins unpredictably, the brain quietly tags trading itself as exciting and worth repeating. Losses don't erase this. In fact, losses set up the very next dopamine hit. Because after a loss, the brain doesn't calmly calculate odds, it starts anticipating the next possible win. This is where a second powerful bias enters the picture: loss aversion. Research consistently shows losses feel roughly twice as painful as equivalent gains feel good. Losing $100 doesn't just feel like the opposite of gaining $100. It feels far worse. That imbalance quietly shapes almost every decision a trader makes in the heat of the moment. When a trade is winning, loss aversion makes traders sell too early just to lock in the feeling of safety. When a trade is losing, that same bias makes traders hold on far too long, hoping it turns around. This single pattern has a name: traders repeat to each other constantly: cut your winners short, let your losers run. It's the exact opposite of what actually works, and almost everyone falls into it anyway. Why? Because in the moment, following your instinct feels far safer than following the math. And once a losing trade is open, a third bias takes over: the sunk cost fallacy. The more money already lost in a position, the harder it feels to simply walk away. It feels like giving up would waste everything already invested, even when staying in costs even more. There is a fourth bias worth naming: the illusion of control. Clicking buy and sell buttons feels like skill, like you're steering the outcome yourself. But short-term price moves are overwhelmingly driven by forces no individual trader controls. News, institutions, automated systems, all pushing prices around at the same time. Yet every click still feels like cause and effect, like the outcome was earned. That false sense of control is part of what makes trading feel so much more engaging than long-term investing. A close cousin of this illusion is the gambler's fallacy. After several losses in a row, it can feel like a win is somehow due next. But price movements like coin flips don't remember what happened before them. 5 losses in a row doesn't make a 6th win any more likely. Yet that belief quietly convinces traders to increase their bet size right when it's riskiest. Bigger bets after a losing streak, hoping the next one finally breaks the pattern. This leads directly into one of the most damaging patterns of all: revenge trading. After a painful loss, the instinct isn't to pause, it's to immediately try to win it back. Trades made in this state are rushed, emotional, and rarely well thought out. One study of retail trading accounts found that trades placed right after a big loss performed noticeably worse. The goal quietly shifts from making good decisions to simply making the bad feeling go away. And that shift almost always makes the losses bigger, not smaller. Winning streaks create the opposite problem: overconfidence. A few good trades in a row can feel like proof of skill, even when luck played the bigger role. This is when position sizes often creep up, and caution quietly disappears. Confidence built on a small sample of lucky trades is one of the most common ways accounts get wiped out. The market doesn't reward confidence. It rewards discipline, and those two things often feel identical from the inside. So far, every bias we've covered points to the same uncomfortable truth. Let's walk through how this actually plays out, step by step, over a single week. Monday, a small account, a hopeful mindset, and a plan to trade carefully. The first trade goes well, a modest, disciplined win. That single win releases a small wave of dopamine and quietly plants a seed. By Tuesday, the plan has already loosened slightly. Just one more trade before lunch. Tuesday's trade is bigger than Monday's and it wins too. 2 wins in a row. The dopamine builds. Confidence builds faster. By Wednesday, checking the account isn't occasional anymore. It's constant. Wednesday brings the first real loss, bigger than either previous win. The instinct isn't to stop, it's to trade again immediately to fix it. Thursday's trades come faster, sized bigger, guided more by feeling than plan. 1 wins, 2 lose. The losses are larger than the plan ever allowed. By Friday, the original plan is gone completely, replaced by pure emotion. The account that started the week hopeful is now down significantly. This isn't a story about one unlucky trader. It's the default path the biases create. Every single decision along the way felt reasonable in the moment. That's what makes these biases so effective. They don't feel like mistakes while they're happening. They feel like intuition, like skill, like finally understanding how the market works. It's only afterward, looking back, that the pattern becomes obvious. This cycle's small wins, growing confidence, a loss, and an emotional chase repeats constantly. Not because traders are careless. Because the brain is doing exactly what it evolved to do. Understanding that difference, carelessness versus biology, changes how this problem should be approached. This isn't about willpower alone. It's about designing habits that work with the brain, not against it. So what actually helps? Let's look at what tends to separate consistent traders from the 90%. The first difference is almost boring. Consistent traders write things down before they act. A trading journal isn't about looking smart later. It's about slowing the brain down in the moment. Writing, "Why am I making this trade?" before clicking buy interrupts the impulsive loop. It forces a gap between feeling and action, and that gap is where discipline actually lives. The second difference: rules are set before emotions are involved, not during. A stop loss decided this morning is rational. A stop loss decided mid-trade is not. Position size is decided the same way as a fixed percentage, never as a feeling. This single habit alone prevents the bigger bet after a loss trap we saw earlier. The third difference: consistent traders treat losses as the cost of doing business.
Every business has expenses. For a trader, a losing trade, within the plan, is simply one of them. That reframe alone removes most of the emotional charge that fuels revenge trading. The fourth difference: they build in distance after a loss, on purpose. A short walk, a closed laptop, even just 5 minutes, enough time for the urge to fade.
That single pause breaks the automatic link between "I feel bad" and "I must trade now." The fifth difference might be the most important. They don't need to trade every day. No clear opportunity is treated as a valid, complete answer, not a failure. This runs directly against the dopamine-driven urge to always be doing something. But sitting still when nothing lines up is itself a skill and a rare one. None of this eliminates risk. Trading and investing generally always involves risk. But these habits shift the odds back toward the trader's favor, instead of working against them. It's the difference between fighting your own brain and quietly working alongside it. Professional traders and fund managers don't rely on excitement. They rely on process. Boring, repeatable process checked again and again outperforms adrenaline almost every time. Which brings us to the most important shift of all, what winning actually means. Most new traders define winning as being right, predicting which way the price goes. But consistent traders define winning differently. Protecting capital, staying in the game. A trader who loses on 6 out of 10 trades can still be profitable if losses are small and wins are sized well. Being right and being profitable are two completely different skills. Most people obsess over the first skill. Almost no one is taught the second. That imbalance, more than anything else, explains why the 90% statistic exists at all. It's also worth asking, who do we actually hear from in this space? The traders who lose quietly disappear. The rare huge winners post screenshots and get loud. That's survivorship bias, and it makes the whole activity look far more winnable than it is. Meanwhile, most professional money managers quietly do something far less exciting. They diversify and hold long-term. It doesn't make for a viral screenshot, but it's what actually tends to work over time. None of this means active trading is impossible to do well. Some people genuinely learn to manage the psychology, but it requires treating your own mind as the primary thing being traded, not just the market. Every bias covered in this video is normal. Every single one of them is human. The goal was never to eliminate them completely. That's not realistic. The goal is simply to recognize them early enough to make a different choice. That single moment of recognition is the actual skill hiding behind every consistent trader. Not predicting the market, understanding yourself. So if you're trading or thinking about starting, ask a different question first. Not how do I predict the next move, but how do I behave well when I'm wrong? That question, more than any chart pattern, decides who ends up in the 10%. This video is for education only. Always do your own research. And never trade money you can't afford to lose. If this helped you understand your own trading habits a little better, that's exactly the point. Thanks for watching and see you in the next one.